What if the biggest silver exchange on Earth is sitting on a math problem it cannot solve, and the clock is already counting down? Because here's the uncomfortable possibility: the system can look liquid on a screen, stable in headlines, and fully stocked in reports, while the physical metal underneath is quietly running out. And if that's true, this isn't just a story about a shiny rock, it's a story about modern life, supply chains, national security, and the hidden plumbing of the financial system. Right now, the claim, based on publicly reported exchange figures, is simple and explosive. There may be far more paper claims on silver than deliverable silver in the vaults. If you've ever wondered how markets can stay calm right up until they don't, this is one of the cleanest case studies you will ever see. Because when the mismatch gets big enough, the market doesn't gradually adjust, it snaps. And that snap doesn't just reprice silver, it reprices trust. Let's slow this down and make it understandable, because the people who win in moments like this aren't the loudest, they're the calmest. Imagine 400 people show up for dinner, and the kitchen only has 100 pizzas. Nobody has to be evil for that to be a problem. Nobody has to manipulate anything. Arithmetic alone guarantees conflict. That's the core idea behind the COMEX delivery debate, and whether you agree or disagree with the conclusion, you need to understand the mechanics, because the mechanics are real. COMEX, the commodity exchange, is widely treated as a global reference price for silver. The problem is that most trading on COMEX is not people buying silver to actually hold silver. It's a paper market: contracts, derivatives, hedges, and leveraged bets. And that sounds abstract until you realize paper markets can grow much larger than the physical markets they're based on. Here's the easiest way to picture it. Imagine a luxury restaurant where people are trading steaks all night long. They're shouting bids, making deals, flipping positions, and exchanging money, yet nobody is actually eating. They're trading menus. They're trading pictures of food. That's what a paper market can become: a high-speed casino built on a real-world product that most participants never intend to touch. Now, if everyone in that restaurant stays satisfied trading menus, the game can go on forever. But the moment a meaningful number of people stand up and say, "No, bring me the steak," the system becomes a delivery system. And delivery systems either deliver or they fail. This is where the COMEX vault categories matter, and most retail investors don't even know they exist, yet they change everything. There are generally two buckets people talk about: registered and eligible. Registered is the silver that's reportedly available for delivery against contracts, the stuff that's ready to move. Eligible is silver sitting in COMEX-approved vaults, but owned by private parties and not necessarily for sale or delivery. And here's the trap: if you add those two piles together and call it total silver, it looks reassuring. But reassurance is not deliverability. You can't pay your restaurant bill with your neighbor's dinner. So the question that actually matters is not how much silver exists in the building, but how much silver can realistically be delivered when delivery is demanded. That's why analysts obsess over registered inventory. Because in a delivery crunch, eligible doesn't magically become registered unless owners volunteer it, at a price they choose. And when a market is tight, owners don't volunteer metal cheaply. They demand a premium or they don't sell at all. So if reported figures show registered inventory falling over time, that's not a fun trivia fact, that's the bathtub draining. And when the bathtub drains while the promises stay high, you get the setup that makes people nervous. Now here where the debate turns from interesting to urgent. Silver isn't a luxury good. Silver is an industrial input. If you want the future: electronics, solar, defense systems, advanced manufacturing, you want silver. You can't build plenty of modern devices without it. So if there's a physical squeeze, the impact doesn't stay in the silver chart, it leaks into production, costs, timelines, and inflation. This is why the most serious silver buyers aren't the loudest ones on social media. They're industrial users who can't afford to be wrong. They don't care about bull markets. They care about uninterrupted supply. And if they sense supply is at risk, they don't debate online, they secure inventory. That's why delivery months matter, and it's why first notice day shows up in these conversations. In futures markets, certain dates force contract holders to decide what they actually want. Do you roll your position? Do you settle financially? Or do you stand for delivery? And when enough participants choose delivery, the system's physical constraints get tested in real time. This is the moment the paper market stops being a paper market and becomes a warehouse with a line outside the door. Now, the dramatic version of this story says, the vault is guaranteed to fail. The cautious, responsible version says, if reported deliverable inventory is low relative to open paper claims and if delivery demand spikes, the system gets stressed, and stress reveals weak points. That's the framing you should adopt if you want to think like a professional: conditional, probability-based, and grounded in incentives. Because the big money doesn't bet on certainties, it bets on asymmetries. And tight physical markets create asymmetry. One of the most revealing indicators in tight metal markets is the lease rate. That sounds boring, but it's a flashlight in a dark room. The lease rate is basically the cost to borrow physical metal. And the moment you hear that, you should ask a sharp question: why would anyone pay interest to borrow a bar of metal instead of just buying it? In normal times, the answer is simple: because borrowing is cheap and it supports shorting, hedging, and settlement needs. In normal times, the cost is low because supply is comfortable. But when borrowing costs jump sharply, when lease rates spike, it's the market's way of whispering, finding metal is getting harder. Not because a headline said so. Because the price of access to metal just increased. And markets don't raise access prices out of politeness. They do it because someone is bidding for scarce inventory. Here's the key: a lease rate spike is not a social media trend. It's a financial signal. It can indicate stress in availability, rising demand for physical, or rising urgency to borrow for settlement and short positions. And if you pair that with falling registered inventory, you start to see why the debate gets intense. Because now you have two independent signals pointing in the same direction. Then you widen the lens. You don't just look at one vault in one city. You look at global flows. You look at Shanghai. You look at London. You look at policy decisions. And this is where the story becomes geopolitical. If major economies treat silver as strategic, whether through stockpiling, restrictions, or reshoring supply chains, that's not a meme. That's nations reacting to material risk. And strategic behavior turns a commodity into a chess piece. Now, the most common retail reaction to all of this is either denial or panic. Denial sounds like, this can't happen, the system is too big. Panic sounds like, buy everything now or you're doomed. Professionals do neither. They build a framework. One practical framework is simple: vault, pressure, position. First, you verify what's actually deliverable and what's just present. Second, you measure the pressure: delivery cycles, lease rates, premiums, and industrial demand. Third, only then do you decide on positioning. Because most people do the opposite. They skip to position. They buy first, justify later, and pray the chart saves them. That isn't investing. That's gambling with a finance vocabulary. Pressure is where this turns into a timeline. Delivery months concentrate decisions. If a meaningful fraction of paper holders request physical, the stress test becomes real. And here's the uncomfortable truth: you don't need everyone to demand delivery. You only need enough people to overwhelm the deliverable pool. If paper claims are large and deliverable metal is limited, even a modest delivery percentage can tighten the system fast. And once a system is tight, small shocks become big events. This is why people argue about failure to deliver. A failure to deliver is not the end of civilization. But it can be the end of an illusion. Because the illusion is that paper exposure equals metal exposure. In normal times, that illusion can hold. In stress times, the market learns the difference between a claim and a bar. And when that difference becomes obvious, you don't just get a higher price, you can get a fractured price. This is where the idea of a divorce comes in: paper price versus physical price. In a clean, frictionless world, arbitrage would close that gap instantly. If physical is higher in one region, traders buy where it's cheap and sell where it's expensive. But arbitrage requires metal. It requires shipping. It requires time. And it requires inventory that's actually available. When physical is scarce, arbitrage doesn't disappear because traders got lazy. It disappears because the pipes are clogged. So you can end up with a screen price and a street price, a futures price and a delivered premium. And if you're holding paper exposure through instruments that settle financially, you may discover you own the screen price, not the street price. That's not a conspiracy. That's contract structure. Which brings us to the part that hurts ordinary people the most: settlement mechanics. If a system can't deliver physical, it has options. It can encourage cash settlement. It can raise margins. It can change rules. And every one of those tools has precedent. Cash settlement sounds polite, here's money instead. But money is only equal to metal if metal is available at that price. If physical premiums spike, cash settlement can feel like being paid in yesterday's price for today's shortage. Margin hikes are another classic tool. If holding contracts becomes more expensive overnight, weak hands are forced to exit, regardless of whether their thesis was right. This is how markets stabilize without solving the underlying problem. They shake out participants. And that's why short-term traders get destroyed in tight markets. Not because they were wrong on direction. Because they were wrong on structure. History gives us two obvious case studies people cite: 1980 and 2011. Different players, different context, but a similar rhyme. Silver threatens to move, pressure rises, rules tighten, and volatility explodes. You can argue about motives all day, but the repeated pattern is what matters for risk management. Because if you don't plan for the rulebook will plan for you. Now here's what could make a modern setup genuinely different. In prior episodes, physical availability was not as constrained as some claim it is today. If physical inventories are truly tighter now, then financial tricks can delay but not permanently erase the problem. You can't print silver. You can't quantitative ease a metal bar into existence. At best, you can ration demand with higher prices. That's what markets ultimately do in shortages. They raise the price until demand backs off or supply responds. But in silver, supply response is slow. And here's a dirty secret most people don't know: a large portion of silver production is a byproduct of mining other metals. So even if silver's price rises, output doesn't instantly surge the way people assume. Mines don't turn on like light switches. Permitting takes years. Investment takes years. Equipment takes years. So you can have a scenario where demand rises quickly while supply responds slowly. That's the recipe for sustained pressure. And sustained pressure is what makes squeezes dangerous. They don't resolve in a week. They resolve when someone finally pays enough to pry metal loose. Now, if you're listening to this and thinking, so what do I do? Good. That's the right question. But the answer isn't panic. The answer is define your risk. Because silver is volatile. Silver can surge violently and then drop hard. Anyone selling you a straight lineup is selling you a fantasy. So you start with risk tolerance. If a 20–30% drawdown would make you capitulate at the worst moment, your position is too large. And if your position is too large, your brain becomes your enemy. Professionals size positions so they can survive being early. Because being early is common. Being wrong is survivable. Being forced out is fatal. So think in layers. Think in time horizons. Think in instruments. Physical silver is simple: if you hold it, you own it. It has no counterparty in the same way a paper claim does. But it has storage, security, and liquidity limitations. Paper exposure is convenient, easy to buy, easy to sell. But it introduces counterparty and settlement structure risks, especially in stressed scenarios. So the smarter framing isn't paper versus physical. What role does each play in my plan? A balanced approach might mean a core position you can hold through chaos and a satellite position you can trade. A plan that assumes volatility, not a plan that prays for calm. And if you want to be truly strategic, you stop obsessing over price targets. Price targets are clickbait. What matters is monitoring the tripwires. Watch deliverable inventory trends over time, not one-day snapshots. Watch delivery demand behavior relative to open interest. Watch lease rates and physical premiums across regions. Watch for signs that industrial buyers are moving from just-in-time to just-in-case. Because that's what smart money does, it changes behavior before it changes headlines. Here's the most important warning I can give you. The most dangerous moment in a squeeze narrative is the final shakeout. Markets often flush late buyers before they break higher. They spike volatility. They trigger stop losses. They create a dramatic drop that makes weak hands sell. Then the move resumes without them. So if you're going to participate in a thesis like this, you must accept emotional warfare as part of the terrain. If you're not prepared for that, don't play. And if you are prepared, you still don't go all in. Because all in is not conviction. All in is ego. Now let's address the bigger picture, because silver is not the whole story, it's a symptom. When a physical commodity becomes the battlefield, it often means financial claims have outgrown real-world capacity. That can happen in metals. It can happen in energy. It can happen in credit. And when it happens, you get the same theme: paper promises meet physical limits. So if silver becomes stressed, the second-order effects show up elsewhere. Manufacturing costs, input inflation, supply chain delays, defense procurement, technology scaling. In other words, this isn't just a trade. It's a macro signal about scarcity and the fragility of infinite liquidity assumptions. And if you want one final thought to anchor all of this, it's this. In a healthy market, price is a discovery mechanism. In a stressed market, price becomes a rationing mechanism. If the system is tight, the market's job is to choose who gets the metal and who doesn't. And the only language markets speak fluently is price. So no, you don't need to panic. But you do need to pay attention. Because when arithmetic meets urgency, the market doesn't ask permission. It just moves. And if you want to survive moments like this, your edge is not secret information. Your edge is calm thinking, clear sizing, and understanding the difference between owning an asset and owning a claim. One last thing, because it matters. None of this is financial advice. It's a framework for thinking. A way to read incentives. A way to watch signals. If you do your homework, verify the current data, and decide your risk logically, you'll be ahead of the crowd that waits for the headline after the move. Because the crowd always arrives late. And in markets, late is expensive.